Good morning and welcome back to Almas Market Mornings, your daily dose of global financial updates. While stocks in the US hover near all-time highs, traders seem to be waiting for the PPI inflation reading and the retail sales data which will be released today. Yesterday was rather uneventful, but one geopolitical soup being brewed is the tension between US and China regarding shipbuilding. US President will consider a petition by trade unions about the non-market policies being implemented by China, which allows it to be which allows it to be a dominant commercial shipping player. Good morning, JK. Your thoughts on market? Even our own very mid cap stocks had quite a bit of beating yesterday. What's your take?
Yeah, good morning, Saraj. Yeah, actually, markets had become quiet yesterday after the CPI report of Tuesday, wanting to see if the deflation indeed had stalled in the US, and of which there will be some indications today also. The PPI numbers are expected to show fairly modest gains, of course, despite this week's somewhat warmer than expected CPI number. All items number is expected at 0.3% higher, and the core is expected at 0.2%. These are month-on-month numbers, and for year-on-year, it's going to be around 1.1 and 1.9% respectively. So these are not very high, but still higher than what has been the trend. So the longer term trends remain compatible with the Fed targets, but the recent readings have suggested, including in the last month's numbers, that disinflation may have been at least on a pause. So that's what the market is really considering, whether that leads to Fed actually pushing the rate cut further towards July. As of the market, discounting does not show much of a change. June shows about 65% probability, down slightly from 70 earlier. And for July, it is, of course, 80%. So that the debate is now on whether between June and July. As of now, still favoring June. Today's numbers, along with the retail sales, which will also give an indication of how the consumption is happening in US economy, and the jobless claims, of course, the weekly numbers that has to be seen in the light of the weak job number, or rather the higher unemployment number that we saw in last week's report. These are numbers. So market's quiet, but definitely going to get more active after these numbers are published. So in equities, it was a slightly negative day. Markets wanting to take profit on the strong rise of the previous day. Just to give you a perspective, S&P 500 has been in one of the best stretches since 2018, and none of the days it has lost more than 2%. So that was one of the biggest feature of S&P 500 rally. On the yields, twos rose 5 basis points, 10, 4 basis points, 30s, 3 basis points, not much considering the volatility that we have been seeing. Market participants, as I said, are still seeing a 65% chance of a rate cut in June. Interestingly, the yield rise in the last three sessions has not helped dollar to rally, particularly the USD yen, which would have been the more reactive to it. Euro made another dash to break higher yesterday despite a big decline in Eurozone industrial production, which was 6.7% down on year-on-year basis and 3.2% on month basis. But the details show that a big slump was due to drop in Irish industrial production by 29%. That was a one-off. So that's the reason why market did not react much. UK published their quarterly GDP that showed a bounce to 0.2%. That is growth compared to a contraction of 0.1% in the previous month. Previous estimate, of course. Industrial production and manufacturing output, of course, showed tepid performance. Japanese yen stayed firm, even as Toyota agreed to the biggest wage hike in 25 years, paving the way for BOJ's shift, in their stance, perhaps, because agreeing to give factory workers their biggest pay in 25 years is probably a sign of things to come, because more large corporations will conclude their wage negotiations by the end of this week, rather by tomorrow, and just 2 days ahead of the BOJ meeting on Tuesday. So that stays the biggest factor, because Japanese central bank has linked their policy move to the wage negotiations If these indeed come high, then there is a fair chance that the market will bet on change in the stance on Tuesday from uh, Japan, and that will have a big implications for the market, of course. Some of the commodities made a very strong advance. Oil held the biggest gain in 5 weeks after the US stockpiles came down. It's now staying above 84. Actually, US inventories dropped for the first time in 7 weeks. Silver rose 4% and copper 3%. Gold's correction halted ahead of 2150 and registered a rise of nearly 0.8%. And its recent 9% rally has been fueled by a massive buying from EM central banks, including China. So, like currencies, commodities have been gaining on expectations that Fed will eventually cut rates. If not June, it may be July, but their next move is going to be cut in rates. That's what is driving the commodities. Rupee saw a rate decline of 0.3% this week as a combination of strong PSU buying, purportedly intervention, then large FDI outflow that was seen yesterday, and somewhat soured sentiment in the equity market impacted. Yes, as you said, there was a big slump in the mid-cap stocks, but it was a general sell-off prompted by profit taking in the Indian stocks. We have been making regular new all-time highs, and that has got halted a bit because we are slowly heading into the election period, and it's very usual to see profit taking ahead of the big events that lie ahead. So this has not been correlated to moves in the global markets, of course. And yeah, so talking of mid caps, everybody knows that these are somewhat illiquid sectors, and therefore it always becomes a herd mentality, whether it is buying or selling. That's what has actually impacted those stocks. But with conviction on India's fundamentals being strong, I think somewhere you will see the buying emerging, but liquidity will be a factor. And of course, if you see more profit taking, then one will have to wait and see before you see a bottom for the stocks. Normally, 10% correction in any stock market is quite usual. We have never seen a 10% correction for Indian stocks for a very long time. So that's the worst case that I'm looking at. Rupee, of course, I don't think we will cross 82.95. Anywhere closer to 83, I expect the central bank also to come and intervene on the selling side. So it should be boxed. But for gains up to 82.50, which we have been mentioning about, we need a break of 82.65. Thank you.
Thank you, JK. And just quickly summarizing, PPI numbers are expected to be higher in the US month on month. Now, markets are considering a pause in disinflation as shown by the recent inflation figures. Euro made a dash to break 1.0950, trading stronger despite a weaker data. But as JK mentioned, it was because of one-off Irish data that it actually, it's a one-off data. For UK GDP showed a growth of 0.2% against the previous print, indicating contraction. And for rupee, 82.95 to 83 will be an attractive sell level. And for any appreciation, we need to see the break of 82.60. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.